In this session, I'm going to focus on one of the powerful derivative instruments which is making heavy inroads into the typical financial markets today. Probably the first of the swap transaction happened, let's say, 4 decades back, 40 years ago. But what we are seeing is a phenomenal growth over the last 40 years. We are seeing a lot of phenomenal growth, and probably one of the major instruments in the OTC market. So we need to understand what a swap is. Just on an overview, when I have to talk about a swap, just like any other derivative, it's an agreement between two parties, right? And this is an over the counter agreement itself, an agreement between the two parties wherein each party agrees to exchange a series of cash flows in future based on some kind of an agreement. A is agreeing to pay something to B, and B is agreeing to pay something to A, and this is not a one time payment. Generally it is a series of cash flows on so the dates on which the cash flows will be exchanged, the way in which the calculation of these cash flows will happen, both of them will be mentioned as a part of this swap agreement. But in short, two parties A and B are getting into an agreement to exchange a series of cash flows at a future date. So it might so happen that A might agree to paying some kind of an interest of fixed 5% on some notional principal amount, let's say $100 million, and B might say, I would be paying whatever is the prevailing interest rate at that particular point, prevailing rate at that particular point on the same $100 million. So the agreement could be in terms of cash flows, or probably it might so happen that A might be agreeing to pay B, let's say $100 every period, and B might agree to pay 6,000 Indian rupees every period. Probably this agreement could talk about payment every 6 months. The exact dates will be highlighted. The payments would be every 6 months, and uh, and for a 3 year period. Let's say that the duration of the payment also would be mentioned. So this is how a swap can be constructed. Generally what we see is the more prevalent and more popular kind of swaps we see today are, one, the interest rate swaps, where both the parties agree to pay different interest rates. So one may say fixed interest rate, the other may talk on floating interest rate on some notional amount for some period at specific intervals of time. So the cash flows payment could happen with respect to interest rates, where we call it as an interest rate swap, or generally it is based on an exchange rate, where we look at it as a currency swap. Though various other things are there, equity returns or probably commodity returns. So there are so many such kind of instruments where the cash flows on one reference is paid to the other party, and cash flows on some other reference is received from the other party. So this is how a swap contract gets constructed. And if I look at it logically, probably a swap is looked at like a series of forward contracts, because forward talks about one single settlement date, and on that day the whole settlement happening, whereas swap is looked at as multiple settlement periods. Whereas on the other side, probably whatever is agreed upon today, the settlement is happening at the end of the expiry of the contract. So forward is also more or less working in the same manner. So forwards and swaps bear a lot of similarities, except for the swap is something can be visualized as a series of forwards, and in majority of the swap cases, or in swaps case, it's only the cash flows that get exchanged, whereas in case of forwards, even there could be a delivery of the underlyings as well, right? So with that as a base, let's try to start understanding the interest rate swaps to start with, and then we'll slowly move towards the currency swaps as well. Typically, the interest rate swap, which is otherwise called as a plain vanilla swap, this talks about an exchange of fixed versus floating interest rate. One party pays fixed and receives the floating. This is the typical plain vanilla interest rate swap. But the amount, which is generally notional in nature, means no party needs to pay this amount. So they could say $100 million is the notional amount. On this notional amount, and the frequency of payment, let's say 6 months, the duration of the swap, let's say 3 years. One party is agreeing to pay a fixed rate on this notional amount, the other party is agreeing to pay a floating rate. So these are the important constituents that go as a part of the swap. So even the dimension for the floating, okay, it is going to receive LIBOR, or probably it is going to receive LIBOR plus 20 basis points, which is plus 0.2%. And the quote is on 6-month LIBOR. Even what LIBOR is typically being used, probably a 6-monthly LIBOR plus 0.2%, whatever is the interest rate that is there, that would be applicable on that 100 million, and whosoever is the floating rate payer, they would be paying that particular amount, and a fixed rate payer would be paying, let's say if they have agreed that they are going to pay 5% fixed, the fixed rate payer is going to pay the 5% to the other party. Now, typically, let's look at one simple swap transaction. Let's say X and Y. Two companies, X and Y, have got into an interest rate swap. X agrees to pay an interest rate of 5%, whereas Y agrees to pay, let's say, an interest rate which is floating, and probably let's say this floating rate is a 6-month LIBOR. And here let's talk about $100 million being the notional amount, and let's say the duration of the swap is 3 years, the maturity of the swap is 3 years, and the payments frequency is 6 months, right? So in this case, X is called as a fixed rate payer because a fixed payment is being done, whereas Y is called as the floating rate payer. So the cash flows are exchanged every 6 months, and for a 3-year period. Now, let's assume the on 1st January 2014, the contract was entered into, and the LIBOR on that day, let's say we are talking about it as 4.5%. Now what we are saying is The first payment for this is going to happen on 1st July 2014. On 1st July 2014, the fixed payer is going to pay, the X in this case is going to pay 5% of 100. But this 5% is an annual rate, but for 6 months I have to take it as half. So probably 2.5 million is being paid by the fixed payer to the floating. Whereas Y, who is the floating payer, the payment that would be made on 1st July is based on the interest rate, based on the LIBOR that is prevailing on 1st Jan. That's a typical point we have to remember. Any payment that is happening in case of floating, the interest rate is decided at the beginning of the period. Whatever is the interest rate that is prevailing at the beginning of the period, it is paid at the end of the period. So whatever was the interest rate that was prevailing on 1st Jan 2014 would be paid at the end of that particular 6 months, which is 1st July 2014. So the payment by the floating rate entity will happen at 4.5% on this, which means it would be 2.25 million. One point that needs to be kept in mind here, there is no uncertainty or no ambiguity with respect to the first payment at any point by the floating payer. No uncertainty with respect to the first payment, because on the day of entering into the contract, whatever was the floating rate, that was applicable, that is what is getting paid at the end of 6 months, because any time the interest rate at the beginning of the period would be typically paid at the end of the period, even in case of a floating payment as well. So that will happen in the first payment, which is 1st July. Then the next payment is going to happen on 1st Jan 2015. Even on that particular date, the fixed payer is still going to pay the 2.5 million only. But this is where the floating payer's payment will differ. From a floating payer's perspective, what comes out is, I will check out what is the LIBOR on 1st July 2014. From here, I have to wait until 1st July 2014. Whatever is the LIBOR that is prevalent on 1st July 2014, let's assume if that comes out to 5.2% on 1st July 2014, then that payment is happening on 1st January 2015 at the rate of 5.2% on 100 million for a 0.5 years period, which is coming out as 2.6 million. So one important point that we have to understand in this case, especially with respect to any floating rate payment, is the interest rate that is decided, that is prevalent at the beginning of the period, typically gets paid at the end of the period. It's not the interest on 1st July 2014 paid on 1st July 2014. It's a very wrong step. The interest as on 1st Jan 2014 is paid on 1st July 2014. The interest on 1st July 2014 gets paid on 1st Jan 2015. So the interest at the which is understood or determined at the beginning of the period is typically paid at the end of the period. This point needs to be very strongly emphasized, because in case of floating rate payments, the first payment is always known. The first payment that you would be making at the end of the first period, this is not just for swap. Any floating rate payment, any floating rate loans that I have taken and I have to pay my loan on a floating rate basis, In all these cases, the interest rate at the beginning of the period would be the one that is applicable for payment at the end of the period. So in this kind of an example, because it's a 3-year swap with 6 monthly payments, we observe that there could be 6 different exchanges of cash flows at different points in time. And generally what happens is, instead of X paying 2.5 million and Y paying 2.25 million, the structuring of these swaps will happen in such a way that the party which has to pay more pays the difference. Right, so probably instead of this paying 2.5 million and receiving 2.25 million, it's as good as saying this party is paying 0.25 million. So the typical structuring of the swap can happen in such a way that one of the parties will pay the difference to the other. And one more important aspect is, whatever we called as the principal $100 million in this case, in general it is only a notional principal. Means no party needs to really exchange this 100 million. It is only used for the purpose of calculating interest. So it's just notional. No party needs to maintain a backup or reserve of this 100 million at any cost. Right? That's the reason we are always using the word notional in the context of interest rate swaps. Now, an important aspect is the swap can very well be looked at as a combination of one floating rate bond plus one fixed rate bond. Swap can always be constructed as a floating rate bond plus a fixed rate bond. Probably look at the X in our example, who was paying pay fixed and receive floating. If I had to look at this or express the same in case of bonds, I can very well look at a long floating rate bond, probably with a face value of 100 million, coupon payments, semi-annual coupon payments happening. So if it is a long floating rate bond, what is happening on a 100 million, whatever is the coupon floating rate, let's say the floating rate is decided based on LIBOR. Whatever is the floating rate at the beginning of the period, this party keeps receiving the floating rate every 6 months on $100 million. So this part is taken care by long floating rate bond, and similarly I can add it up with a short fixed rate bond. Short fixed coupon bond means this company has issued a fixed coupon bond again with a face value of 100 million. Means this company has to pay a fixed coupon of 5% every 6 months, and probably the face value on maturity. Here the face value is paid on maturity, here the face value is received on maturity. So these two are negating themselves out, offsetting themselves out, which means it is very much creating a kind of a swap. So from a fixed payer's perspective, a fixed payer swap. So when I say fixed payer is automatically a floating receiver. So when I have to create a fixed payer swap, it is as good as it is going long on a floating rate bond plus going short on a fixed rate bond, fixed coupon bond. Whereas when I'm looking at fixed receiver swap. Fixed receiver is more like a floating payer for us. So for him it goes exactly the opposite. So I am going short on a floating rate bond, floating coupon based bond, whereas I am going long on a fixed coupon bond. Right? So one important point that we can understand from this transaction is a swap can very well be constructed. A swap can very well be constructed in terms of bonds, coupon based bonds, one long position and one short position, both of them having a same maturity period, the coupon payments going in line with the coupon payments of the swap, going with the cash flow exchange periods of the swap, and one being the long position and the other one being a short position. So this kind of a logic will help us to create a swap using two bonds as well. Now, why should organizations use swaps? What I could really see is the swaps can really help organizations to convert, let's say, floating liabilities to fixed, or vice versa, or convert floating assets, floating rate based assets to fixed, and vice versa. All combinations can come out. Probably let me take one simple example, let's say with the liabilities. I'll talk about X, which I have used earlier. X is paying fixed 5% on the swap. Right? Now let me take an example. X was having a loan. X has taken a loan, let's say on a floating rate basis with a bank, some bank 1. X has taken a loan on bank 1, from bank 1, let's say on a floating rate basis. So let's say the loan that it has taken was at LIBOR plus 0.2%. Now which means the liability which X is having is like a floating rate liability. Now what I am saying is, let's say it has combined that with a interest rate swap it has got into with Y, wherein it is paying a fixed 5% and it is receiving LIBOR. And here obviously because it has taken a loan, it is paying LIBOR plus 0.2%. Now add up all these three transactions. Receive LIBOR, pay LIBOR, neutralized off. Pay 5%, pay 0.2%. So overall is coming out as, at any point in time, this particular company has to pay 5.2% on the loan that it has taken. So in reality, it has taken a loan on a floating rate basis, but by getting into this interest rate swap where it ended up as a fixed payer, it is able to convert its floating rate liability into a fixed rate liability as well. So the banks, the companies can use swaps to transform their fixed floating liabilities into fixed or fixed to floating. So a simplified mechanism is, if at all the objective of a company is convert floating liabilities to fixed, then it can enter as a payer swap. It can enter into a payer swap transaction that will convert a floating rate liabilities into fixed. But if I am talking about fixed rate liabilities to floating conversion, then probably enter in as a receiver swap. This is something which we need to understand. Okay, let me put a grid. Liabilities and assets. Let's say if I want floating to fixed conversion or fixed to floating conversion. If I want my liabilities to be converted from floating to fixed, I am getting in more like a payer swap, fixed payer swap. So fixed paying, receive floating. Otherwise, I'll get into a fixed receiver swap. Fixed receiver is pay fixed, sorry, receive fixed, pay floating. But look at it in terms of assets now. Let's say this company is already having an asset which is, let's say X is having an asset which is giving a fixed rate. Let's say it is having an investment. X has invested somewhere which is giving a 4.5% return every time. Let's say per year over the next 3 years itself. Now it has already got into a transaction with Y where it says it is going to pay 5% fix, receive LIBOR. Now here also, because it is an investment, it is receiving 4.5%. Now the net is what? It is receiving LIBOR minus 4.5 minus 0.5%. Pay 5%, receive 4.5%. So overall it is receiving LIBOR minus 0.5%, which means earlier it was receiving 4.5%, but by getting into this kind of a swap, it was able to convert a fixed rate asset into a floating rate asset. Right? Fixed receipt on an asset to a floating kind of a receipt, floating returns. So for this again I can get into a fixed payer swap, and in this case I could get into a fixed receiver kind of a swap. Fixed receiver, you can always look at it as a floating payer and vice versa. One important concept, companies as a part of their hedging strategy, they can very well use the swap transactions to convert their fixed and floating assets and liabilities into the other by entering into an appropriate swap transaction. Alright. Now, the other dimension with respect to the swaps that I am going to bring in is generally that X and Y, if at all they are non-financial kind of companies, it's very rare that they try to come together and get into a swap. In large number of cases, they are intermediated by a financial intermediary. It could be an investment bank or it could be any other financial institution. And this party will bring these two together and tries to make a commission in the transaction. Generally, in case of interest rate swaps, the commission is to the extent of 3 to 4 basis points, which is 0.03% to 0.04%. Right, this is the transaction that we are talking of. So in general, what could very well happen is for X and Y. Earlier they were directly, we showed a case where they were directly interacting, but now we talk about a financial institution coming into picture. So X will have a separate deal with the financial institution, Y will have a separate deal with the financial institution. So probably it's like X and Y may not know that each one is having a deal with the financial institution at all. and probably earlier it was looking like X was paying 5% to Y fix, but now it may so happen that it may end up paying 5 point, let's say 0.15%, because the intermediary will be charging that 1.5 basis points. So, but this will provide some kind of advantage to X, that it need not search out for Y, right? And from a wise perspective also the same logic, because it's very difficult that finding exactly X and Y which are taking exactly opposite positions, and exactly opposite positions, that too exactly at the same point in time for the same notional amounts. It's really very hard to identify this entire case. So what the financial institution typically do is they start acting as market makers. So as a part of the market makers, they try to come out with the bid price, bid rate, as well as the ask rate, which is the offer rate. So at what rate they are ready to enter as a fixed payer, at what rate they are ready to enter as a fixed receivers. Right, what is the rate they are ready to enter as fixed payers, what is the rate they are ready to enter as fixed receivers. So such kind of progression has come out as a part of the swap markets, because it is very much essential that these two parties should not know each other. I mean, it's not necessary that these two know each other, and these two may not have exactly the same size of risk with them. So probably the financial intermediary is bearing that kind of a risk, because it is entering as a counterparty to each of the transactions of both X and Y, right? And even if one of these companies is defaulting, it's the responsibility of the financial institution to adhere to the to payments of the other one, which means there is a heavy risk that is involved with this financial intermediary. But whatever is that 3 to 4 basis points that it is taking is a kind of a partial compensation for that high risk that it is taking, assuming that one of the party is going to default. But if none of the parties are going to default, that 3 to 4 basis points, or 0.03 to 0.04%, is a kind of a definite gain to the financial intermediary. And now looking at the market making role, even if X wants as a fixed payer swap and Y is not available at all, X wants to enter as a fixed payer, the financial intermediary is ready to enter as a fixed receiver or a floating payer. Without having any kind of an offsetting swap, the financial intermediary can very well enter into the transaction, which means there is a heavy risk that is being taken by the financial intermediary. So there should be a careful quantification and the hedging. These are some of the important things that are happening at the end of the financial intermediary, because without knowing who the counterparty is, who is going to be performing the offsetting transaction, the financial intermediary is taking this initiative to enter as the counterparty. So the bid rate, the ask rate, and probably the average of the bid and the ask is what comes out as the typical definition of the swap rate. Whenever we are talking about the market intermediaries coming into picture, that additional difference from the swap rate to the bid rate or the ask rate is the kind of a commission which the typical financial intermediary is charging from this perspective, right? Now, assuming that X has gotten into a swap transaction with the financial intermediary, from a process standpoint, a confirmation is being provided. Confirmation is more like a legal agreement which is signed by both X and the financial intermediary from both the parties, and whatever the contents they have been drafted based on so many experiences. International Swaps and Derivatives Association, ISDA, is what we call as International Swaps and Derivatives Association, ISDA. This is the body which has drafted the various procedures associated with this master agreement, and where lots of details with respect to the terms and agreements, and even the process in which the computations are done, the frequency of the payments, the time period of the swap, and what will happen in case any of the parties is defaulting, how should it be handled. All these things are maintained as a part of the swap agreement, the ISDA master agreement. And it even talks about when did this agreement start, and what are the payment dates, what happens if the next payment date is a public holiday or some kind of a holiday. Then when would the payment be made? Is it the next working day or the previous working day? So when is it typically done? And even from the fixed as well as the floating payers perspective, from a fixed payers perspective, we talk about what is that fixed interest rate that the fixed payer would be paying, and even basis on which what is the day count basis on which the payment would be made. Is it actual by actual in terms of the payment periods, or is it actual by 360, or is it actual by 365? We talked about different kinds of day count conventions earlier, which talks about the duration, and between the two settlement dates, what is the number of days between the two settlement dates, or is it 30 by 360 kind of convention? What is the kind of a convention that is used for the day count, both for a fixed payer as well as the floating payer, and on the dates on which the real payments are going to be made? All these things are very clearly highlighted as a part of the swap confirmation document, which is otherwise highlighted as a part of ISDA master agreement. All right. Now, the next important thing that is worth looking at is, though we think of getting into a swap agreement for converting the fixed assets or fixed liabilities into floating, or vice versa, the major argument that comes out in these lines is the comparative advantage. The question of comparative advantage. That is where it is believed that swaps are playing a much bigger role. It's like this. We have already seen that any interest rate swaps can convert a fixed rate liability into a floating rate liability, and vice versa, or a fixed rate asset into a floating rate, or vice versa. So what companies typically try looking at is, they try to raise a loan. If at all they are planning to raise a loan, they will try to raise it in a market where they have a comparative advantage. I'll talk about what we mean by that. They try to raise a loan in a market where they have a comparative advantage, and they try to combine that loan with an interest rate swap to finally convert it from one form to the other. So when I'm saying comparative advantage, I'm primarily talking about the difference that is existing in the borrowing rates. Probably for this, let me take a simple example to illustrate it. I talk about two companies X and Y. So from an X perspective, if it is raising the loan in a fixed rate market, if it wants to raise a loan in a fixed rate market, let's assume that it can raise it at 6% interest, whereas Y can raise at 7% interest. But if it is growing in a floating rate market, let's say X can raise a loan at LIBOR plus 0.2%, whereas Y can raise a loan at LIBOR plus 0.7%. So, first of all, in both the markets, whether it is a fixed rate market or a floating rate market, for Y, it is the loan is costing more. Whether it is rising in a fixed rate market or in a floating rate market, probably the rate at which it can raise the loan could be much higher compared to X. This could be probably because of the credit rating for Y could be worse compared to that of X. But let's say both of them would like to borrow $100 million for 5-year period, and these are the rates that are available for them. So we will assume here, like this person, this particular company wants to borrow at a fixed interest rate, but this wants to borrow at a floating interest rate. So the capital which X wants to raise, it wants to raise at a floating rate, whereas Y wants to raise at a fixed rate. Now, Y is having comparative advantage in the floating market. Y is having comparative advantage in the floating market. Why is it so? You see the difference. Though in both the cases Y is having a higher rate compared to X, the difference in the rates here is 1%, whereas here it is only 0.5%. And because of this reason, why we say in whichever one the difference is lesser, we say that the party is having a comparative advantage in that market. So here I say Y is having a comparative advantage in the floating market, whereas X is having a comparative advantage in the fixed market. Okay. Now, to take advantage of these comparative advantages, what Y will try to do is Y will try to raise a loan. Y raises loan in the floating market. Though it wants fixed, we are saying Y will raise a loan in the floating market. So, which means for Y, the cost of the loan is going to be LIBOR plus 0.7%. Right? The cost of the loan is going to be LIBOR plus 0.7%. Whereas X raises a loan in the fixed market. So X will raise, the cost per X is going to be 6%. The loan is going to cost 6% per X. So this is what will happen, and that is where they get into a mutual swap. Now X and Y will get into a mutual swap. An interest rate swap is something which both of them are going to get into. And because of this interest rate swap, they create it in such a way that X will pay, let's say, a fixed 6.3%. X will pay, X will X has raised in a fixed rate loan, right? X raises a fixed rate, so it will pay floating. So it will X will pay, let's say, LIBOR, and let's say Y is going to pay 6.3%. Let's say the deal is structured in this way. Then what is happening? Look at the payments of X now because of this interest rate swap. It has to pay at 6%. It has to pay 6%, and it has to pay LIBOR to Y, and it is receiving 6.3%. So the net is it has to pay LIBOR minus 0.3% or 30 basis point. So it is able to raise a floating rate loan at actually LIBOR minus 0.3%, whereas if it had directly gone into the floating rate market, it would have raised it at LIBOR plus 0.2%. So it got an advantage, or probably if we say this deal is structured at, let's say, 6.1%. Then it has received 6.1%. It was able to raise it at LIBOR minus 0.1%. So whereas if it had gone directly for the floating rate market, it would have raised the loan at LIBOR plus 0.2%, which means it has got the benefit of 30 basis points. Now look at the other side with respect to Y. Y has raised a loan in the floating rate market, so it has to pay LIBOR plus 0.7%, and because it has got into an interest rate swap, it is paying 6.1% and it is receiving LIBOR. So probably it is looking like it is paying 6.8%. So it's able to raise the loan at, it's as good as its cash outflows are to the extent of 6.8%, which is fixed. But if it had gone for a direct loan in the fixed income market, it would have costed it 7, which means even this got a benefit of 0.2% or 20 basis points. So the deal got structured in such a way that X is getting a benefit of 30 basis points, Y is getting a benefit of 20 basis points by raising the loan in a market where there is a comparative competitive advantage. Comparative advantage is there, and then entering into a fixed rate, fixed to floating kind of an interest rate swap. So the deal can be structured in whatever manner, but the benefit to the parties is going to be to the extent of 50 basis points, which is nothing but the difference between these two differences. This difference is 1%, this difference is 0.5%. So by structuring the swap in a better way, the 0.5%, which is the difference between these two, would be the gain that could be combinedly enjoyed by both the parties. By raising a loan in their comparative advantage markets, getting into an interest rate swap agreement with the other party, they should be able to combinedly gain zero point 0.5 basis points. But if in this case, instead of they directly getting in, if a financial intermediary has come into picture, this financial intermediary, as we have discussed, will typically be charging 3 to 4 basis points. So overall, again, that 50 basis points profit probably might be divided in such a way, not 30-20 or something like that. Probably this guys may be getting 28, this guy may be getting 18, whereas the financial intermediary would be sharing that 4 basis point. So this is one important reason why, especially when there are opportunities available in such a way that there is a comparative advantage for one company in one kind of a market, whereas the other company in the other market, and whereas they want to raise a loan in the in the opposite market. So comparative advantage in the floating market but wants to raise a loan in the fixed market, or comparative advantage in the fixed but want to raise a loan in the floating. So whenever such kind of situations are there, the interest rate swap can become one of the most powerful instruments to operate out. But generally people talk of why will this differences exist? First of all, between fixed, where the difference we showed as 1%, whereas in floating we have shown the difference of 0.5%. If the differences were really existing, can't people use arbitrage opportunities using swaps and remove that opportunity altogether? In reality, that may not be possible at all, because in fixed markets, generally the difference is based on, let's say, a 5-year interest rate or something. Whereas in case of floating, it might be based on a 6-month LIBOR rate. So because of this, the differences can quite comfortably exist. Whereas in case of floating, there could be a lot of flexibility available to the lender. He can change the condition. Instead of saying LIBOR plus 0.7%, he can change the, depending on the credit risk that is associated with the company, he can change the borrowing terms to, let's say, LIBOR plus 1.2%. So there is a flexibility of changing at somewhere down the lane, or probably there is a possibility that the loan itself can be scrapped up. So what we see is typically the rates differences in the fixed need not be the same as the rate differences in floating. So this opportunity might be present even if the swap market has been existing for quite some time. The arbitrage opportunities can be executed. This kind of differences with respect to the interest rates can quite comfortably be existing, which means comparative advantages can quite comfortably be present in either the fixed markets or in the floating markets as well, right? And just to understand, the swap rate are not LIBOR rates. LIBOR is mostly a substitute for risk-free rate. Swap rate need not be risk-free, but it is more and more closer to risk-free itself. Sometimes swap rates can very well be used as a proxies for LIBOR, especially if we are getting into the valuations of the swaps kind of instruments. So now let's get into the process of valuation of interest rate swap. When I'm trying to evaluate an interest rate swap, I can look at it from two dimensions. There are two major ways in which valuation of the interest rate swap happens. One, valuation in terms of bond price. I look at a swap as I look at swap as one fixed rate bond and one floating rate bond. So based on a combination of one fixed rate and floating rate bond, we can do the valuation of the interest rate swap, or we can look at the interest rate swap as a series of FRAs, series of forward rate agreements. So these are the two ways we'll look at in terms of valuation of the interest rate swap. And before I get into the valuation process, just like a forward, at the initiation, on the day the swap is initiated, the value of the swap is going to be zero. Means neither the fixed payer nor the floating payer is having an advantage on the day zero, on the day of entry into the swap agreement. But as the days passes, the value could become positive or negative. So finding out the value at each of the points at any particular point in time is what is bringing out our valuation process. So to understand this method of valuation, let me take one simple example. We'll take both the mechanisms, see how the value is coming out in both the mechanisms. So let's say we are talking about a swap. Let me take an example of a swap agreement. Let's talk about 6-month LIBOR payment. And so the floating rate payment. So we are talking about pay 6-month LIBOR, receive, let's say 8% fixed. And we are talking about semi-annual compounding here, right? Or probably we could have talked about continuous compounding also, fair enough. I'll take semi-annual compounding. And the notional principal, let me take the notional principal as $100 million. So whenever the swap was entered, it still has a remaining life of 1 year 3 months. And what we are seeing is the LIBOR rates for 3 months. Let me take the LIBOR as 10%. For 9 months, let me take the LIBOR as 10.5%. And for 15 months, let's say the LIBOR is 11%. And when we are talking about the 3 months before today, when the LIBOR was reset, let's say the LIBOR at that point 3 months back, which is like minus 3 months from today, let's say it was at around 10.2%. Now I want to find out the value of each of these, the value of the interest rate swap now. At this particular moment, I want to find out what is the value of this interest rate swap, right? So let me try putting it out. The time duration that is available to me, it's 0.25 years from now, 3 months, 0.75 years from now, and 1.25 years from now. And then I have fixed payers cash flows. I know as a fixed payer. Now I am looking at if I am looking at from the perspective of receive fix. So this is a fixed receiver kind of an instrument, right? From we are trying to evaluate from pay floating fixed receive fixed kind of investor. So this can very well be modeled as long fixed rate bond plus short floating rate bond. This could be a combination because I have issued a floating rate bond, so I have to pay in terms of floating, and I have invested in a fixed rate bond, so I would be receiving in fixed. So I am receiving fixed. So what I will be receiving is because it's a 8% annual coupon, I will be receiving 4 at the end of 3 months, 4 at the end of another 3 months, and even 104 at the end of 15 months, which is 1.25 years. So I can very well get into finding the present value, right? I'll try to find out the present value of all these payments. So it is coming out as 4 divided by e power, let's say what is the R for 3 months. I'm seeing that the LIBOR rate is 10%, RT. So this is giving me that the present value is 3.901, whereas in this case 4 divided by e power R. In this case for 9 months the R is going to be 10.5% into T, coming out to 3.697, and the last one 104, because we are talking of it as a bond. a fixed payer. So this is like a short fixed rate bond. So I am doing it as e to the power of r. In this case, it is 11% is the r into t. So giving me that this is the case. So the present value of all the fixed payments, the present value of the fixed payments, so the value to the fixed payer, value to fixed payer, or probably the fixed payers cash outflow present value is coming out to 98.2379. Now what about the floating? As per the floating, 3 months back when the interest rate was reset, he was supposed to, the LIBOR rate was 10.2%. So the payment would be made based on this 10.2%. And that too we have only 3 more months to maturity. So if the payment was to be done at the rate of 10.2%, for 6 months it is going to be 5.1%. So after 3 months, the payment that is going to come out now as a part of floating receiver's perspective, this is fixed receiver. So you are going to receive 98.23, and because it's a floating payer, we'll see as per the floating payment, what we need to understand is the interest rate was decided, let's say 3 months back, 10.2%. This would be paid 3 months from now. So the payment that is going to be made here, I know the coupon is going to be 5.1 and the interest rate would be reset at this period. So when I am trying to find out the present value of all these future, this is where the coupon is going to be the same as the interest rate, which means the bond will be selling at par itself. So what we typically do is all these will work out to 100 and this one is 501. So the cash flows at the end of the next 3 months is going to be 105.1 and nothing more than that, because the interest rate is reset, the coupon is reset to the interest rate, which will again work out when the coupon and the interest rates are same, the bond will be selling at the par value itself. So it's as good as saying after 3 months the coupon is going to be 5.1 and after that whatever is the coupon, they are all based on the interest rates at this particular point in time. So whenever the coupon rate and the interest rate are the same, the bond will be selling at par. So at any point in time when we talk about the coupon reset date, on the coupon reset date, we always see that the present value of future cash flows in case of floating rate bond is always equal to the par value or face value itself. But between the two coupon dates, here this was the date on which the coupon was reset. On this day, probably the value would have been 100 only. But I am trying to do the value on this date. So the coupon reset date and the value date are different. If that is the case, I will have based on the previous last coupon reset date, which is the LIBOR date. So I'll have the coupon according to that, and probably for all the future, the present value is still going to be the par value or the face value itself. So at the end of 3 more months, the cash flow is going to be plus 101 So I can find out the present value with respect to the floating pair. I'll take it as e to the power of r for 10. It is going to be 10% and probably t is 0.25. So this is going to work out to 102.5. So the paying wise, I'm going to pay 102.5. Receiving wise, I'm going to get 98.23. So the value for this payer is going to be 98.23 minus 102, which is working out to minus 4.267. This is the way we can evaluate the value of this interest rate swap. The value of this interest rate swap is going to be minus 4.267 for the party who is paying floating and receiving fixed. So this is the kind of a transaction that will work out if we are using a bond kind of stuff to evaluate the interest rate swap. Now we would like to go ahead in terms of using FRAs, a series of FRAs to value the interest rate swap. In this case also I can look at the time slots being 0.25, 0.75 and 1.25. Fair enough. Now from a fixed cash flows perspective, which is a fixed receiver perspective, I can typically see that 8% is what is going to come up in all the three intervals. So I'm not looking at it as a bond, I'm looking at it as a fixed rate, as an interest rate FRA, forward rate agreement. So whatever may be the market rates, I will be receiving 8% per annum and I would be paying at the rate of whatever is the LIBOR rate. Now, from the floating perspective, this is where, if at all I want to get into the floating part, what are the LIBOR rates for 3 months LIBOR? For 3 months LIBOR, it is 10.2%, and it is, 3 months LIBOR is, so here it was 10.2%, whatever should be the payment which was set 3 months back. And the next one is going to be around 10.5%, and this is going to be 11%. Now what we are looking at is we are constructing this as a forward rate agreement. So we'll try to find out the forward rates taking these LIBOR rates as the spot rates. So the first one is still going to be 10.2%, whereas from the second one I'll take it as R2T2 minus R1T1 by T2 minus T1. So R2 T2 minus R1 T1 divided by T2 minus T1. This would be the typical payment that is corresponding to 3 months to 6 months kind of a period. So it would be paid at the rate of 10.65%. So the receiving is at the rate of 4%, 8%. The payment is at the rate of 10.65%. The same logic I can put between 9 months to 15 months. R2 T2 minus R1 T1 divided by T2 minus T1, giving me that the forward rate in this case is going to be 11.75, which means the floating rate payer in this case is going to pay, or floating rate payer is typically going to pay as per this. So this 10.2% is per year. So for half a year, it is going to be half of it, which is multiplied by 0.5, and 100 million is the notional amount. So the floating payer is going to pay 5.1 and probably 5.32 and 5.875. I have to take it. Okay, this is 5.1. Fair enough. Here, this I have to take it at the rate of 10 because I'm talking about point 25 years from now. So I can't take point 2. So here I am taking it as 5.37. Here the floating rate payment, the first payment anyhow is based on 5.2. So I'll continue with that. The second payment I am computing the forward rate separately, which is based on R2T2 minus R1T1. So I am getting 5.375. And here I need to even do a semi-annual compounding because these are the forward rates for continuous compounding. So I'll do a semi-annual compounding. In this case, the first one I'm not much bothered, whereas in this case I'm trying to find out the semi-annual compounding, wherein I'm trying to equate the formula. I'm trying to equate the formula Rm equal to m times e to the power of Rc by m minus 1. So if I am using that particular formula in this case, I am getting something like m times, so which is twice e power Rc by m, e to the power of Rc by m minus 1. So this is m into e to the power of Rc by m e to the power of Rc by m. I take 1 out here. Probably yes. This is giving me 11.04% as the interest rate, and I mean that should be the payment that should typically happen. So the floating payment for me will come out as, in the first it will come out as 5.1. In the next it will come out as this number multiplied by zero point 0.5 multiplied by 100. So the floating payment is going to be this much, and the floating payment here is going to be this much. So from this perspective I can find out the net cash flow, which is coming out as this minus this in each of the periods. I can find out the net cash flows in each of the periods. These happen to be the net cash flows, and I can find out the present value of those net cash flows. This is going to be 3 months later, so I'll take it as e to the power of r, I'll take as 10% into t. So this is the present value here. And what about this? This divided by e to the power of 10.5% multiplied by 0.75, giving me minus 1.4, and the last one is also going as this number divided by e to the power of 11% multiplied by 1.25. So if I'm taking the overall present values of all of them, this is operating out to minus 4.26, which is exactly same as what we have got when we have used the bond kind of a mechanism also. So just to summarize it, from a fixed rate perspective, there is no change. But from a floating rate perspective, if I am going with based on the LIBORs, using the LIBORs, I am computing the forward rates, and these forward rates are primarily coming from the when I used R2T2 minus R1T1, it is based on the assumption of compounding, continuous compounding of the interest rates. But with respect to the bonds, I'm with respect to the floating rates, I'm looking at semi-annually compounded kind of rates. So all the future for all the forward rates that I have got using the continuous compounding basis, I convert them using the semi-annual compounding basis. Based on them, I will find out what are the floating payments that are typically required, and based on them, I am getting the net cash flows, finding out the present value of the net cash flows, resulting in the total value of the interest rate swap. Here I am not looking at principal exchanging at all. So that's how we can get into the valuation of an interest rate swap, either using a bond valuation kind of methodology, where I look at one long position and one short position. Either one, if the long is in fixed rate bond, the short would be in a floating rate bond, and vice versa. So the interest rate swap at any point in time, it is designed in such a way that initially the value of the swap is going to be zero, but as it progresses, the value of the swap is going to be either positive or negative. And whenever we are looking at the positions wise, if at all we are talking of a pay fixed kind of a scenario, when we see that the forward interest rate is greater than the fixed agreed upon rate, we see that the value will be positive or value will be a negative. If the forward interest rate is lesser than the fixed rate, we see that in this case the forward interest rate always, after the semi-annual computation, the forward interest rate always was higher than the fixed rate, 8%. So that's where we are seeing that the payments are much more compared to the receipts, and in all the periods the payments are more than the receipts, which is resulting in a overall negative kind of a value to the party. So just by looking at the forward interest rates, comparing them with the fixed rate, we can directly make out which party is typically going to gain and which party is going to have a negative position altogether. So these are some of the things that are typically getting covered as a part of the interest rate swap. Now we'll move on to understanding the currency swap. All right. Now that we have looked at the interest rate swap, the other important one we would focus on is the currency swap, another popular kind of swap agreement between two parties. Here, when two parties A and B are getting into a currency swap, there is an exchange of both principal as well as interest, and one party exchanges it in one currency, the other party does the same in the other currency. So in the currency swap, we see the exchange happening in two different currencies, but the both principal as well as interest, these two are exchanged between the parties. Whereas in the typical interest rate swap, we talked about the exchange happening only on the interest, and the principal was simply a nominal kind of a the principal is more nominal in nature, whereas interest was exchanged. Whereas when we talk about the currency swap, both the parties in fact exchange principal as well as the interest. The principal amount, what would be exchanged? Let's say one country would be paying in dollars and the other country would be paying in Indian rupees. Now both the countries have to clearly specify what is the principal amount that would be exchanged at the beginning of the contract. Generally, at the beginning of the contract, whatever is exchanged would be purely based on the exchange rate that is prevailing on the day of entry into the contract. So probably if I say $1 is equal to some 60 Indian rupees, then it could so happen that the principal that would be exchanged between the two parties at the initiation of the contract could be, let's say, $10,000. One party would be exchanging $10,000 and probably would be receiving 600,000 Indian rupees, because if each dollar is worth 60 Indian rupees. So this is the kind of principal negotiation that happens at the beginning of the contract, at the beginning of the swap. But the way the swap transaction gets created is like, when I'm talking about two parties A and B exchanging the same, probably it may so happen that A would be lending $10,000 to B, and B in turn would be giving 600,000 Indian rupees. So this is on the beginning of the contract. And let's say this contract requires paying interest on a 6 monthly basis. So after 6 months, we see that A would be paying, it's like A has raised a loan of 600,000 rupees, B has raised a loan of $10,000. So A would be paying interest on 600,000. Let's say the interest rate on Indian rupee is 8%. So the A would be paying 8% on 60,000, 600,000 Indian rupees. So it would be paying an interest rate of 48,000 rupees. Whereas B would be paying the interest rate on dollars. It has received $10,000, and let's say the interest rate in United States is around 5%, then $500 is what would be paid by B to A. And the same logic will continue. Let's say after 1 year, this party would be paying 48,000 rupees and this party would be paying $500. This would continue until the expiry of the swap contract. The swap contract would be defined, let's say, for a 3-year period with a semi-annual payment. Now, so after 6 months, one exchange will happen. After 1 year, after 1.5, 2, 2.5, and 3. So finally, at the end of 3 years, when the when the swap contract is expiring, the principals would be exchanged back. This from B would be exchanging back the $10,000, and A would be exchanging back the 600,000 rupees. Now, what could happen in this entire process is the exchange rates at each of these places could be different. And depending on how the exchange rate is moving, one of the parties will be at an advantage, the other would be at a disadvantage, which means the value of the swap contract at the beginning, at the initiation, though it is equal to 0 because no party is at an advantage or disadvantage, initially it is fixed based on the spot exchange rate. But after that, the interest rate amounts could be fixed, and based on that we don't know whether the exchange rate could be appreciated or depreciated, because of which the party paying in one currency would be at an advantage compared to the party that is paying in the other currency. So that is that is how companies can typically get into the swap market. Though there could be a lot of speculation kind of transactions, the primary intention again with the usage of swap comes with respect to converting or transforming the liabilities in one currency to the other, or transforming assets from one currency to the other. Or just like the way we have discussed about the interest rate swaps, even it is to take advantage of a comparative advantage. Take a comparative advantage and try to get loans at at a much advantageous or win-win kind of a position, right? So let's look at how this can be done. But the most common form of currency swap which we see is fix to fix. Means the interest rates in both the currencies are fixed. In case of a typical interest rate swap, we said the common one is one party paying fixed, the other party paying floating on a notional principle. But when we talk about the typical currency swaps, the most common one is a fixed for fixed kind of a currency swap, which means the interest rates in both the currencies are automatically are fixed to a large extent, though there could be a fix for floating, floating for fixed, all such kind of combinations very much possible. Now, if I want to see how this currency swap can help me in transforming the liabilities. So liabilities exposed in one currency to the other. So the borrowings are assets. The borrowing, let's say I have done in currency X or probably in Indian rupees, but I want to reduce the exposure to Indian rupee and probably take an exposure towards the US dollars. If that is the case, probably let's talk about a company X raising a loan for 100 million 100 million rupees in India at probably 8% interest rate. Then it can get into a swap agreement. So with that swap agreement, it can lend, it can give 100 million rupees to Y in exchange for, let's say the rupee dollar rate is 50 rupees a dollar. In exchange for 20 in exchange for $2 million, it can give 100 million rupees. Now the payment wise, the interest rates also could be fixed, saying the rupee interest rate is 8%, the dollar interest rate is 5%. So in a net, if I am seeing to the bank, X has to pay at the rate of 8% in dollars, in rupees, and here it is receiving at the rate of 8% in rupees, and here it is paying at the rate of 5% in dollars. So the net is working out as these two are getting offsetted out. The net is coming out as pay at the rate of 5% in US dollars. So that is how the companies which have raised loans in Indian rupees can very well convert the effective loan into US dollars by getting into a swap agreement with a concerned counterparty. So the swappings can typically convert the exposure to one currency from one currency to an exposure to other currency quite drastically in the same manner. Similarly, we can talk about the companies getting into a swap agreement primarily from a comparative advantage perspective. So we have looked at when we discussed about the interest rate swap also. Let's say we are talking about two companies X and Y. X, when it is raising a loan in the dollar market, let's say the loan was available for X at 5%, but if Y had to raise it in the dollar market, let's say it was 7%. Whereas when it was trying to raise a loan in the Indian rupee market, let's say for X it was available at 8%, whereas for Y it is available at 9%. Now what we are saying here is in both the markets, Y is for Y it is costing more. So there is no absolute advantage for Y in any of the markets. It is costing more. Probably the credit rating of Y would have been much lesser compared to X, and that is one of the prime reasons for why it could be costing more. But what we see always in the world of comparative advantage is the gap here is 1%, whereas the gap here is 2%. So wherever the gap is lesser, so in this Indian rupee the gap is lesser. So why it looks like Y is having a comparative advantage. Y is having a comparative advantage in the Indian rupee market compared to X. Right? Y is having a comparative advantage in the Indian rupee market compared to X. So what Y will do? Y will raise a loan of, let's say, 600,000 Indian rupees at the rate of 9% in the Indian market, right? And now X will raise $10,000 loan in the US market. Now here the intention should be X wants loan in Indian rupees and Y wants loan in US dollars. This is one more important point. X wants loan in Indian rupees, but it is having a comparative advantage in US dollar, whereas Y wants a loan in US dollars, but it is having a comparative advantage in the Indian rupees. So it is raising loan in the Indian rupee, and now these two will come into a swap agreement, X and Y. X will give the $10,000 which it has raised in the US market. X will be swapping the $10,000 with 600,000 Indian rupees. And the interest rates might be fixed in such a way, probably X would charge, X would be charging, let's say, 6.5%. And Y would be charging, let's say, 8.5%. Now what is happening? These two have got into such kind of an agreement that X would be lending $10,000 to Y at 6.5% interest rate, and Y would be lending 600,000 Indian rupees to X at 8.5%. Now let's look at this. X, though it has given $10,000 to Y, it has given it at 6.5%, so it is going to gain 1.5 because it has to pay only 5% to its bank. It is gaining 1.5% here, right? It's getting a gain of 1.5%, whereas Y on the other side, it has lent $600,000 at 8.5%, but it has to pay to its bank 9%. So probably we are able to structure it in such a way that X has given a loan to Y at X to Y. Let's say it has given at 6.5%, and Y has raised a loan in the Indian market, and it has loaned it at, let's say at 7.5%. Now what is that we are saying? X is able to get 1.5% benefit in the Indian market because it was able to raise a loan which it wants in the Indian rupee. It was able to raise it at 7.5%. So it is getting a 0.5% benefit. Whereas the same logic when we take it in the form of Y is able to raise a loan in the US dollar market at 6.5%, whereas if it directly goes into the US dollar market, it's going to cost it 7%. So both of them are able to get a competitive, because of the comparative advantage, both of them are able to make a gain of 0.5% by getting into this kind of a swap agreement. So swap agreement would have been in such a way that X would be whatever the $10,000 loan raised by X in the US market, it swaps and receives at the rate of 6.5% every month in the and at the same time Y is able to raise a loan of 9% in the Indian market, and it is able to swap at the rate of 7.5% in the US market. So both of them are having their own competitive comparative advantage, and both of them are able to gain because of the swap. That is what is the benefit that comes as a part of the comparative advantage argument. Now, the next thing when we discuss about the valuation part of the currency swaps, just like interest rate swaps, the when I'm looking at the valuation of the currency swaps, there are two things that can be looked at. Either I can value them as two different bonds in two different currencies. I can value them as two different bonds of two different currencies, or I can value them as a part of two different forward rate contracts. So using either of the methodologies, I can typically look at the valuation of this particular currency swap. So I look at the currency 1 related valuation separately, currency 2 related valuation separately, and from there compute the difference being the value of the swap. So now if I am looking at one small numerical example that demonstrates all this, let me take a simple numerical example, both in terms of bonds as well as the forward rates, to understand the swap concept, valuation of the swap concept comfortably. So the interest rates, let's talk about N based interest rate, let's say is around 4% per year, and it is here I'll assume that it is flat for the entire duration of the swap. And I'm also talking about the interest rate in the US. Let's take it as 9% per annum. And let's take both of them as continuous compounding itself to start with. Okay, both of them are going with a continuous compounding mechanism. And let's say the swap has been entered, and corresponding to the swap payments, right? For the swap payments, I am saying N payment, N related, the party which I am talking about, let's say, is N receipts. This party receives in N at the rate of 5%, and it pays in US dollar, let's say at the rate of 8% every year, and let's say it's an annual payment. And at the beginning, whatever the principles that got exchanged, let's talk about N being 1200 million N, and which is working out to 10 million US dollars. So what I could very well make out at that point is $1 is equal to $1 is working out to 120 N. That is what $10 million has taken it to 1200 N. And now let's say the current exchange rate, I look at it, let's say at the rate of $110 N per dollars. Now in this case I want to do the value of the swap, and what I can really look at is the swap duration, I mean swap outstanding period is 3 more years, let's say. So the next 3 years is what the cash flows are going to come out of the swap. Now in this case, I can look at it as two different things. One, a yen based value I can find out, and I'll find out the dollar based value. And based on this, the difference will be the value of the swap. So here what is that we are saying? This party would be paying, when it has got into the swap, it is receiving 5% on the N. So the total N were 1200 N. So the N receipts, probably now if I call it as N receipts in year 1, 2, 3, the next 3 years, it is supposed to receive 5% on 1200 N. So 60 N it's going to receive in the first 2 years, and the principal is also exchanged, so 1260 N is going to be received in the third year. And the present values of the N receipts, so I can discount this 60 by e to the power of the N interest rate currently is 4% into T. So which is giving me the present values to be somewhere around these numbers, and the total present value of the N receipts is going to be 1230.54554 N. Alright, this is the total N that is received today. Similarly, I can talk about the dollar payments. The dollar payments are happening, the dollar exchange, the dollar interest rate is 8%, and it is worth $10 million. So $10 million at the rate of 8% is working out to $0.8 million. So zero point 0.8 would be the payments in the first 2 years, and in the third year even the 10 would be received, 10 would be paid, the principal would be exchanged, so resulting in 10.8. And for these dollar payments I can find out the present value. This number divided by e to the power of the dollar interest rate is 9%, multiplied by e power of t, which is this one. So these work out to be the dollar payments should be something like this. So overall the present value of the dollar is coming out to something like this. $9.64 is what, $9.64 million is what this is working out to. So from this, right now we said that the current exchange rate is going to be 110 yen per dollar. So this I convert it into number of dollars. Right now the benefit is around, right now the receipts are to the extent of $11.18 million. Payments are to the extent of $9.64 million. So the gain, which is the value of the swap, is typically going to be the difference between the two, working out to 1.542 million dollars. That is what is the gain, or that is what we call as the value of the swap. So this is the mechanism which we look at when we are going ahead with valuing the swap as two different bonds. One bond is a dollar denominated bond, which would be the payments. The other bond would be n denominated bond, which would be the receipts. The difference between the two is what is creating the value of the swap. But now, when we typically go with evaluation of forward contracts, the same logics typically do come in. Years, when I'm looking at year 1, 2, 3, this is the same. The payments wise, the dollar payment, I'll take it here because it's a payment, I'll take it as a negative number, minus zero point 0.8. In each of the years, it's going to be the same, the minus zero point 0.8 itself. And probably I can look at n receipts. Here also the n receipts is going to be a 60n in each of the years. So these are going to be the receipts. And this is where I look at it as forward exchange rate. Now now that I have the spot rates, I'll look at it in terms of computation of the forward exchange rate, which I can very well compute using the spot rates E power R minus RF into T. So we know that when the deal was initiated, the exchange rate was 120, and currently the exchange rate is 110. So 110 N per dollar. So for 1 N, I can find out what is the current exchange rate. I'll take it as 1 divided by 110. So 0.009 is what is 1 N equal to. So based on that, I can find out the 1 year exchange rate. So 1 year, after 1 year, the current exchange rate is going to be this much. 0.009091. So after 1 year, the exchange rate is going to be S naught into e to the power of R minus RF into T. So R minus RF into T anyhow is 1. So I can take it as 0.009557. So at the end of 1 year, the exchange rate is going to be 0.009557. Then that's where I can try finding out after 2 years what could be the exchange rate. After 2 years, applying the same logic, this multiply S naught multiplied by e power R minus RF. R minus RF is always 5% into 2. So after 2 years, it is going to be 10047. So I can take after 2 years, this is going to be the exchange rate, and probably after 3 years, whatever is the exchange rate, I can very well find out this multiplied by e power R is 5%, T is 3 years. So 0.010,562. So based on this exchange rate, I can convert the N into the dollar, right? So N to dollar payment. So I'm converting all these N's of 60s into dollars based on the exchange rate at that particular point, which is saying this would be the typical payment in all these denominations. And even the principal also would be exchanged here. So the principal that are probably here itself, we can talk about the principal that is going to be exchanged also. So here we'll take it as minus 10.8, and this I'll take it as 1200 so that it can accommodate both of them. So this is coming out to something like this, and instead of 1200 I need to take it as 1260. So these are the dollar versions of the N. So the receipts, these are receipts. The receipts which are received in N by applying the exchange rate at that particular point, these are converted into dollars in this way. So the net, if I am looking at, the payment is -8, the receipt is zero point 0.5. So the net is still a negative, and if I look at it across here, the net is more positive, resulting in an overall gain. The overall is coming out to a gain of around 2 point. Where is the gain coming up to this much? Okay, so these are the numbers, and now I have to take the present values of each one of them also. I have to look at the gain as a present value. So this I will be discounting. This is dollar. So e power RT. R I'll take the dollar into T. E power RT is taken, and finally I do the summation. I should get the same as what I have got when we 1.542996. This is the same which we are getting when we have gone even by valuing it as a two different bonds. So either I treat the forward exchange rates. I take the forward exchange rates 1 year down the lane, 2 years down the lane, 3 years down the lane, using the fundamental of S naught into E power R minus RF into T, and using that convert the N receipts into equivalent dollar receipts. So I have dollar payments, I have dollar receipts, take the net, take the present value of all of them, which is going to give you what is the net gain that is being made in this process. So this is how we can very well get into the valuation of the currency swap. Generally, at the initiation of the swap, on the day the swap contract is initiated, let me reiterate, the value of the swap is zero itself. And but after the initial exchange of the principal, the swap contracts are changing in value depending on how the exchange rate is typically getting into. Alright. Then one more important aspect with respect to the swap contracts we need to be comfortable with is the concept of credit risk, because the swap contracts generally are OTC contracts, over the counter. They are mostly private arrangement. There is no exchange involved in the swap contracts. So there is a good possibility of a credit risk coming up as a part of the swap contract. One of the parties, there is a possibility of default. But from a financial institution which is acting as an intermediary, if none of the parties are defaulting, then there is a typical profit that is made by the financial intermediary, and the financial intermediary looks like it's fully hedged. But even if one of the parties into the transaction is going into financial difficulties and it is defaulting, it becomes the responsibility of the financial intermediary to honor the other party, because generally in all the swap contracts the financial intermediary acts as a market maker, and it takes the opposite position of the contract, and shielding both the parties from knowing each other. So the if at all one of the parties is defaulting, the financial institution can lose very badly if the value if its value in the contract is very much positive. So it typically it typically tries to work out on the collaterals and the various other aspects to protect itself from that kind of huge losses that can crop up as a part of this exposure. But few more things with respect to the credit risk. Generally, the credit risk associated with the swaps will be much lesser compared to the loan with the same notion, same principle. Because in case of swap, generally interest rate swap, the principal is just notional, and whatever the settlements that are happening at regular intervals of time, it's only the difference between the two cash flows. So the amounts that are typically at risk are much lesser in case of swaps compared to an underlying loan. The loan might have been given by one party to the other, and a default on the loan could have a very serious impact and a very high impact on the value of one of the parties. The loss could be potentially higher, which means the credit risk is going to be much higher in case of a loan compared to a swap, because in a swap it's only a small fraction of the value of the loan that is getting exchanged, and that too in the interest rate swap it's even more lesser compared to a currency swap. In currency swap, at least there is a principal that is getting exchanged, and because of the principal that is getting exchanged, there could be a possibility that one of the parties may default, and the volume could be the value of the amount could be much higher. Whereas in the interest rate swap, it's only a notional amount, and what is really exchanged only is the interest rate. So the loss that is associated is much lesser in case of an interest rate swap. So even when we are looking at a comparison between an interest rate and currency swap, generally the currency swap can have a greater value at the time of default compared to an equivalent interest rate swap. And here there should be another important distinction that has to be brought out with respect to the swaps: the difference between the credit risk and the market risk that comes up. Wherever we are talking about a default by a counterparty, when its position is negative and the other party is getting exposed, when its value is positive, when the party is actually gaining, it's not able to get the amount from the other party because of the default of the other party. In that case, when the value of the contract for that party is positive, but there is a possible default by the counterparty. In that case, this company is getting exposed. This party is getting exposed more and more to the credit risk. So, which means its value will be positive here, but the counterparty is defaulting because the counterparty's value is negative. The counterparty is defaulting in this process. So that is where the credit risk is typically arising. But when I am talking about market risk, because of the market variables like interest rates or exchange rates, variations, volatilities, we see that the value becomes negative. When the value of the position is becoming negative, then we are talking about the position being exposed more and more to market risk, not the credit risk. So market risk generally is hedged, is offsetted by getting into various hedging transactions or some kind of offsetting contracts. So there are various procedures to reduce or bring down the market risk, but that's not the case with respect to the credit risk, because credit risk is more associated with the counterparty defaulting. So basically doing some kind of collaterals, nettings, these are some of the various mechanisms that can be planned to actually work with the credit risk. But in general, market risk, where the value goes negative, getting into a proper hedging practices, getting into a proper offsetting kind of contracts, the market risk exposure to interest rates, exposure to exchange rates can very well be reduced. So this kind of an understanding is very much expected out of all these swap instruments. Of course, a bit more understanding in terms of other forms of swap. Though these two are the most common kind of swap instruments we come across, there are many various other variants as a part of the swaps. We talk about equity swaps, we talk about total return swaps, we talk about commodity swaps. So I'll try to cover all these different kinds of swaps in a session later. But the prime importance for us is to understand, at least in good detail, the mechanism of operations of the interest rate swaps as well as the currency swaps, the two major swap instruments across the world. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.